What if I told you that the biggest enemy to your investment returns isn't the market, it's you? Not Wall Street crashes, not recessions, not even bad luck. It's the decisions investors make every single day, chasing hot stocks, trusting flashy fund managers, jumping in and out of the market, and paying fees they barely notice, but that silently drain their wealth year after year. This book, The Little Book of Common Sense Investing by John C. Bogle, delivers a message so simple that most people ignore it, yet powerful enough to outperform the vast majority of professional investors over the long run. Bogle wasn't a hedge fund celebrity. He didn't promise overnight riches. He didn't sell excitement. Instead, he built one of the most successful investing philosophies in history and founded Vanguard, a company that changed how millions of Americans invest. Here's the uncomfortable truth. Most investors are playing a winner's game and turning it into a loser's game. The stock market itself is incredibly generous over time. Businesses grow, profits compound, innovation creates value. But somewhere between the market's return and the investor's pocket, money disappears, lost to fees, taxes, bad timing, and emotional decisions. Bogle calls this the relentless rules of humble arithmetic, and they're unforgiving. If the market returns 8%, but you give away 2% in costs and another 1 to 2% in bad behavior, you're no longer compounding wealth, you're sabotaging it. And here's the part Wall Street doesn't want you to hear. Trying harder often makes it worse. The more you trade, the more you pay. The more you chase performance, the more you buy high and sell low. The more you trust forecasts, the more you're betting against math. So what's the alternative? Bogle's answer is radical in its simplicity. Don't try to beat the market, own it. Instead of searching for the needle, buy the haystack. Instead of predicting the future, accept uncertainty. Instead of paying for hope, invest in reality. This book isn't about getting rich quick. It's about getting rich for sure, slowly, steadily, and sustainably. Warren Buffett himself called this approach common sense, and yet, common sense is incredibly rare in investing. In this video, we'll break down the core ideas of the Little Book of Common Sense Investing, why most investors underperform, how costs quietly destroy wealth, and how a boring, disciplined strategy can help you keep more of what the market gives you. No hype, no speculation, just timeless principles that have stood the test of decades. If you want excitement, investing isn't for you. But if you want results, this book might change the way you think about money forever. Let's begin. Chapter 1 of the Little Book of Common Sense Investing opens with a simple parable that sets the foundation for the entire book, the story of the Gatrux family. This is not a metaphor meant to entertain, it is a mathematical illustration of how investing truly works over time. The Gatrux family owns 100% of all U.S. businesses. These businesses generate earnings, pay dividends, and grow steadily over the years. Because the family owns everything and never trades, they receive the full return of American capitalism, all dividends and all capital growth, with no costs deducted. Their wealth compounds naturally, driven entirely by business performance. This represents the ideal investment scenario: long-term ownership, zero friction, and patience. Then, a second group enters the picture: the helpers. These are brokers, managers, bankers, advisors, and intermediaries. They don't create business value, but they charge fees for trading, managing, and advising. Over time, these helpers take a growing share of the market's returns. Eventually, the Gatrux family begins to trade among themselves. They hire professionals to manage money, attempt to outperform one another, and react to market movements. Each transaction comes with costs: management fees, commissions, taxes, and turnover. The key insight is simple but devastating. Before costs, all investors as a group earn the market return. After costs, investors earn less than the market return. This is not an opinion, it's arithmetic. As more money flows to intermediaries, the share of returns going to the actual owners, the investors, shrinks. What once was a zero-cost system becomes a high-cost ecosystem where complexity benefits the helpers, not the owners. Bogle uses this parable to introduce one of the book's core principles. Investing is not about beating other investors. It's about minimizing the slice taken out by costs. The market itself is not the enemy. Other investors are not the enemy. The enemy is friction fees, expenses, taxes, and excessive trading that compound negatively over time. Chapter 1 makes one foundational point clear. If you own productive businesses for the long term, wealth creation is powerful and reliable. But the more layers you insert between yourself and those businesses, the more your returns are diluted. This parable sets up the central question of the book. How can individual investors reclaim their fair share of market returns? The rest of the little book of common sense investing is Bogle's answer to that question. Chapter 2 focuses on a critical distinction that most investors fail to understand: the difference between business returns and investor returns. John C. Bogle argues that while these two may move together in the short run, they inevitably diverge over time, and confusing them leads to poor investment decisions. Bogle begins by defining investment return into parts. The first part is the investment return generated by the business itself, which comes from dividend yield and earnings growth. This is grounded in economic reality. Companies earn profits, pay dividends, and reinvest to grow. Over long periods, this business return is relatively stable and predictable. The second part is speculative return, which comes from changes in market valuation, specifically how much investors are willing to pay for those earnings. This is driven by emotions, expectations, and market sentiment, not by business fundamentals. In the short term, speculative return can dominate. Rising optimism pushes prices higher, while fear pushes them lower. But over the long term, Bogle emphasizes a key principle: speculative return cancels out. Market valuations eventually revert toward their historical norms. What remains is business reality. To support this, Bogle examines historical data from the U.S. stock market. He shows that long-term stock returns closely track the growth of corporate earnings and dividends, not changes in valuation. Periods of high returns are often followed by lower future returns when prices become detached from fundamentals. This leads to Bogle's concept of rational exuberance, unlike irrational exuberance, which describes market bubbles. Rational exuberance recognizes that stocks are attractive investments because businesses grow over time, but that attractiveness has limits. Paying too high a price for growth reduces future returns. Bogle warns investors against extrapolating recent performance into the future. When stock prices rise faster than earnings, future returns mathematically decline. This is not a forecast, it is arithmetic. The chapter reinforces a core message: successful investing is not about predicting market sentiment, but about understanding business economics. Investors who focus on price movements, forecasts, and market narratives are speculating. Investors who focus on owning businesses and capturing long-term earnings growth are investing. Chapter 2 concludes by reminding readers that markets fluctuate, but business reality always wins in the end. Investors who anchor their expectations to fundamentals and ignore short-term noise are far more likely to achieve durable, long-term results. This chapter sets up the book's broader argument: discipline, realism, and patience matter more than prediction. Chapter 3 builds on the previous chapters by reinforcing a central idea: successful investing comes from owning businesses, not trading stocks. John C. Bogle urges investors to align themselves with the long-term growth of corporate America, rather than short-term market speculation. Bogle introduces Occam's razor, the principle that the simplest explanation is usually the correct one, applied to investing. This means that the most straightforward strategy, owning productive businesses at low cost and holding them for the long term, is more reliable than complex strategies built on forecasts, timing, or manager selection. He contrasts two approaches. The first is investing, which focuses on business fundamentals such as earnings growth and dividends. The second is speculation, which focuses on price movements, market sentiment, and expectations about what other investors will do next. Bogle argues that modern markets have increasingly shifted towards speculation, even though speculation does not create long-term value. The chapter emphasizes that stocks are not just pieces of paper. Each share represents ownership in a real business with real cash flows over time. Those cash flows determine returns. Price fluctuations may dominate headlines, but they are secondary to business performance. Bogle revisits historical market data to show that long-term stock returns have closely mirrored the growth of corporate earnings and dividends. Investors who stay invested through market cycles benefit from compounding, while those who trade frequently interrupt that process. A key warning in this chapter is against complexity. Bogle explains that complexity in investing often serves the interests of intermediaries rather than investors. Complex products, strategies, and forecasts increase costs, taxes, and turnover, all of which reduce net returns. Simplicity, by contrast, minimizes friction. He also addresses the illusion of control. Many investors believe that by analyzing more data, watching markets closely, or reacting quickly, they can improve results. In reality, these actions often lead to worse outcomes due to emotional decision-making and higher costs. The core lesson of Chapter 3 is straightforward: own the businesses, ignore the noise, and let time do the work. Investors who focus on long-term ownership and keep their approach simple are more likely to capture the returns that businesses generate. Bogle concludes that successful investing does not require brilliance or prediction. It requires discipline, patience, and respect for basic arithmetic. By casting your lot with business rather than speculation, you place the odds firmly in your favor. Chapter 4 introduces one of the most important concepts in the entire book: the difference between a winner's game and a loser's game, and how most investors unknowingly turn investing into the latter. Bogle borrows this framework from tennis. In a winner's game, success comes from skill and well-executed actions. In a loser's game, outcomes are determined mainly by mistakes. Investing, Bogle argues, is naturally a winner's game at the market level, but it becomes a loser's game at the individual investor level. Why? Because costs and bad decisions compound negatively. At the aggregate level, all investors together earn the gross market return. This return comes from dividends and earnings growth. But once costs are deducted, management fees, trading commissions, taxes, advisory fees, the net return to investors is always lower than the market return. This is not theory, it is arithmetic. Bogle calls this reality the relentless rules of humble arithmetic. The rules are simple and unavoidable. Gross return minus costs equals net return. The higher the costs, the lower the investor's share. He emphasizes that professional management does not change this math. Active managers compete against one another in a zero-sum environment before costs. After costs, the system becomes negative-sum. As a group, active investors must underperform the market. The chapter explains how frequent trading worsens the problem. Turnover increases transaction costs and accelerates tax liabilities, further reducing returns. Investors who chase performance, switch funds, or attempt market timing add friction at every step. Bogle also highlights the behavioral element. Many investors believe they can outsmart the market, but confidence does not overcome arithmetic. Even above-average skill is often overwhelmed by below-average costs. The result is a paradox. The more investors try to win, the more they lose. By reacting to short-term market movements and pursuing outperformance, they convert a system designed to reward patience into one dominated by errors. Chapter 4 reinforces a core principle. Investment success is determined less by what you earn and more by what you keep. Minimizing costs, reducing turnover, and avoiding unnecessary complexity are far more reliable than attempting to beat the market. Bogle concludes that winning in investing does not require extraordinary insight. It requires humility accepting market returns and discipline refusing to give those returns away to costs and mistakes. This chapter lays the mathematical foundation for the index fund strategy that follows in the rest of the book. Chapter 5 exposes what John C. Bogle calls the grand illusion of mutual fund investing. The widely reported performance of mutual funds does not reflect the actual returns earned by the investors who own them. Bogle begins by distinguishing between fund return and investor return. Fund return measures how a fund performs based on its holdings, assuming a constant investment. Investor return, however, reflects the real-world experience of shareholders, including when they buy and sell. These two returns are often very different. The reason is behavior. Investors tend to buy funds after periods of strong performance and sell after periods of weak performance This pattern leads to buying high and selling low. As a result, the dollar-weighted return earned by investors is consistently lower than the time-weighted return reported by the fund. Bogle supports this argument with long-term data showing that the average mutual fund investor significantly underperforms the funds they invest in. The gap is not small, it compounds over time and can reduce lifetime returns dramatically. The chapter also highlights the role of marketing and performance reporting. Fund companies advertise past performance rankings, creating the illusion that superior results can be selected in advance. In reality, top-performing funds rarely remain top performers. Performance leadership changes constantly, driven largely by randomness and changing market conditions. Bogle explains that performance chasing is self-defeating. When money flows into hot funds, those funds often face higher costs, capacity constraints, and style drift. Future returns then decline, while investors who arrive late capture less of the upside and more of the downside. Costs amplify the problem. Actively managed funds typically carry higher expense ratios and higher turnover, leading to greater trading costs and tax inefficiency. These costs further widen the gap between reported fund returns and investor returns. The central message of Chapter 5 is clear. The investor's behavior is just as important as the investment itself. Even a good fund can produce poor results if investors misuse it. Bogle concludes that the solution is not better fund selection, but better investor discipline. By using low-cost, broadly diversified funds and holding them for the long term, investors can narrow or eliminate the gap between market returns and the returns they actually earn. This chapter reinforces a recurring theme of the book: simplicity, patience, and consistency matter more than chasing performance. Chapter 6 expands Bogle's cost framework by addressing a factor many investors overlook: taxes. While fees and expenses are visible in fund disclosures, taxes are often hidden, yet they can be just as destructive to long-term returns. Bogle's central argument is straightforward. Taxes reduce what investors keep, and like fees, they compound negatively over time. From the investor's perspective, a dollar lost to taxes is no different from a dollar lost to management costs. The chapter explains how taxes arise primarily from portfolio turnover. When a fund manager trades frequently, capital gains are realized and passed on to shareholders, even if those shareholders did not sell their own shares. Investors can owe taxes simply for owning a fund that trades aggressively. Bogle highlights the difference between tax-efficient investing and tax-inefficient investing. Actively managed funds tend to generate higher taxable distributions due to frequent trading. Index funds, by contrast, have low turnover, which allows gains to remain unrealized and taxes to be deferred, sometimes for decades. Tax deferral is powerful. Bogle emphasizes that deferring taxes allows more capital to remain invested and compound over time. Even if taxes are eventually paid, the investor benefits from years of compounding on money that would otherwise have been lost. Earlier, the chapter also addresses the impact of dividends and capital gains taxes on after-tax returns. Investors in high-turnover funds often face a constant tax drag, reducing their effective annual return over long periods. This drag can cut final wealth by a significant margin. Bogle reinforces that tax management does not require complex strategies. The most effective approach is structural. Choose low-cost, low-turnover funds, hold them for the long term, and place tax-inefficient assets in tax-advantaged accounts when possible. Another key point is that taxes are controllable, unlike market returns. Investors cannot control earnings growth or interest rates, but they can control turnover, holding periods, and fund selection. Ignoring taxes is therefore a voluntary mistake. Chapter 6 concludes by restating a core theme of the book. What matters is not the gross return, but the net return after all costs. Fees, trading costs, and taxes all come from the same place, the investor's pocket. By treating taxes as a cost and minimizing them through simple, disciplined investing, investors can materially improve their long-term outcomes without taking additional risk. Chapter 7 addresses a concern many investors share. What if future stock market returns are lower than they have been in the past? John C. Bogle approaches this question not with prediction, but with arithmetic and realistic expectations. Bogle begins by reviewing historical stock returns, noting that U.S. equities delivered strong long-term performance throughout the 20th century. However, he cautions investors against assuming that these returns will automatically repeat. Market returns are driven by fundamentals, dividend yield, and earnings growth, and both fluctuate over time. He revisits the framework introduced earlier. Long-term investment return equals dividend yield plus earnings growth, adjusted by changes in valuation. If starting valuations are high and dividend yields are low, future returns are mathematically constrained. This is not pessimism, it is logic. The chapter explains that during periods of elevated market valuations, investors effectively pull future returns forward. Higher prices today reduce expected returns tomorrow. As valuations normalize, speculative return can become a headwind rather than a tailwind. Bogle emphasizes that lower future returns are not a reason to abandon stocks. Equities still represent ownership in productive businesses and remain superior to most alternatives. For long-term growth, the issue is expectation, not allocation. He warns that unrealistic expectations often lead to destructive behavior. When investors expect double-digit returns and fail to achieve them, they are more likely to chase performance, trade excessively, or abandon their strategy at the wrong time. The solution Bogle offers is discipline and adjustment, not prediction. Investors should save more, spend less, and maintain realistic return assumptions. If returns are lower, the appropriate response is higher savings and lower costs, not higher risk. Chapter 7 also reinforces the importance of cost control in a lower return environment. When gross returns decline, costs consume a larger share of the investor's outcome. Keeping expenses low becomes even more critical. Bogle makes a key point: no one knows future returns with precision, but investors can control their behavior, costs, and diversification. Attempting to forecast markets is unreliable. Building a resilient strategy is not. The chapter concludes by reframing the issue. Lower returns do not mean investing is broken. They mean that investors must rely even more on the principles outlined in this book: simplicity, diversification, patience, and low costs. In uncertain return environments, these principles are not optional, they are essential. Chapter 8 addresses the temptation many investors face, trying to pick winning stocks or funds. John C. Bogle argues that this approach is both inefficient and unnecessary. Instead of searching for exceptional performers, investors are better served by owning the entire market. Bogle begins by examining the reality of stock market returns. While the market as a whole delivers solid long-term results, only a small percentage of individual stocks generate the majority of total gains. These winners are difficult to identify in advance, and many once successful companies later underperform or fail entirely. The problem, Bogle explains, is that stock selection requires correct decisions, identifying winners early, and holding them long enough to capture their full gains. Most investors fail at one or both: behavioral mistakes, selling too soon, reacting to volatility, or chasing new opportunities further reduce success. Bogle extends this argument to mutual funds. Although some funds outperform for a time, consistent long-term outperformance is rare. Performance leadership rotates, and yesterday's top funds often become tomorrow's laggards. The more funds compete to beat the market, the more their collective results revert toward the average before costs. This leads to Bogle's central recommendation in Chapter 8: own the entire market through broad-based index funds. By doing so, investors automatically hold all the winners, including the few extraordinary performers that drive long-term returns. There is no need to predict which companies will succeed. The chapter emphasizes that diversification is not just risk control, it is return assurance. Owning the market ensures that investors capture the full return of capitalism, rather than risking underperformance by missing key contributors. Bogle also highlights the cost advantage of indexing. Broad market index funds have minimal expenses and low turnover, reducing both direct costs and tax drag. This structural efficiency gives index investors a persistent edge over active strategies. Another key point is patience. Even with an index fund, returns will not be smooth. Markets experience volatility, drawdowns, and long periods of underperformance. However, owning the market eliminates the need for constant decision-making and reduces the likelihood of behavioral errors. Chapter 8 concludes by reframing success in investing. The goal is not to find the next big winner, but to capture the returns that the market reliably provides over time. By buying the haystack instead of searching for the needle, investors increase their odds of long-term success while minimizing risk, cost, and complexity. Chapter 9 focuses on a persistent investing mistake, assuming that past success indicates future skill. John C. Bogle explains how investors are often misled by randomness, mistaking short-term performance for long-term ability. Bogle begins by examining historical performance rankings of stocks and mutual funds. He shows that yesterday's winners frequently become tomorrow's losers. Market leadership rotates constantly, and periods of strong performance are often followed by periods of underperformance. This pattern is not surprising. It is a natural result of competition, valuation changes, and chance. The chapter emphasizes that markets are highly efficient in incorporating information. When a company or fund performs exceptionally well, expectations rise, prices increase, and future returns are mathematically reduced. What once looked like a bargain becomes expensive, making continued outperformance difficult. Bogle introduces the idea that luck plays a much larger role in short-term results than most investors are willing to admit. In any large group of competitors, some will outperform simply due to randomness. Over short time frames, it is almost impossible to distinguish skill from luck. The problem arises when investors chase these apparent winners. By reallocating money toward recently successful funds or strategies, investors are often buying at peak valuations. When performance regresses toward the mean, as it frequently does, returns disappoint. Bogle supports this argument with data showing that long-term persistence in fund performance is rare. Funds that rank in the top quartile over one period have little chance of remaining there in the next. Costs, market conditions, and competitive pressures erode any temporary advantage. The chapter also highlights behavioral bias. Investors are naturally drawn to stories of success and confident managers. Marketing reinforces this bias by highlighting recent performance while downplaying risk and randomness. Bogle stresses that randomness cannot be eliminated, but its impact can be reduced. The most effective way to do this is through broad diversification and low-cost indexing. By owning the entire market, investors avoid the need to identify skill and avoid the risk of betting on false signals. Chapter 9 reinforces a central theme of the book. Trying to outguess the market often leads to underperformance. Investors who chase past winners are not increasing their odds, they are increasing their costs and their exposure to disappointment. The chapter concludes with a clear message. Long-term investment success is not about identifying exceptional managers or strategies. It is about recognizing the limits of prediction, respecting uncertainty, and structuring a portfolio that does not depend on being right about the future. Chapter 10 examines a common investor behavior. Seeking professional advice to select winning mutual funds. John C. Bogle challenges the assumption that advisors, consultants, and rating systems can reliably identify superior funds in advance. Bogle begins by acknowledging that many investors feel overwhelmed by choice. With thousands of funds available, turning to experts seems logical. However, the chapter makes a clear point. Most advice focuses on past performance, which is an unreliable guide to future results. He analyzes popular fund rating systems and advisory recommendations, noting that they often rely on historical returns, star rankings, or recent trends. These metrics may describe what happened, but they offer little insight into what will happen next. As market conditions change, yesterday's strengths often become tomorrow's weaknesses. Bogle emphasizes that advisors themselves are part of the cost structure. Advisory fees, whether explicit or embedded, reduce net returns. Even well-intentioned advice must overcome a higher hurdle just to match the market after costs. The chapter also addresses conflicts of interest. Some advisors are compensated through commissions, revenue sharing, or incentives tied to fund selection. These arrangements can subtly influence recommendations, even when disclosures are provided. The result is advice that may benefit the intermediary more than the investor. Bogle reinforces a recurring theme: the collective wisdom of experts does not defeat arithmetic. As a group, professional advisors cannot add value after costs because they operate within the same zero-sum environment as active managers. Another key issue is overconfidence. Investors often believe that access to expert advice gives them an edge. In reality, advice frequently encourages fund switching, tactical adjustments, or style rotation actions that increase turnover and taxes. Bogle contrasts this with a simpler alternative: structural investing decisions. Instead of trying to identify winning funds, investors should focus on asset allocation, diversification, cost minimization, and long-term discipline. These factors have a far greater impact on outcomes than fund selection skill. The chapter concludes with a caution, not a prohibition. Advice can be valuable when it emphasizes planning, behavior, and discipline. But advice focused on beating the market through selection or timing is unlikely to succeed. Bogle's message is clear: before paying for advice, investors should ask whether it improves their odds or merely adds another layer of cost. In investing, simplicity and humility often outperform expertise and prediction. Chapter 11 centers on one of John C. Bogle's most forceful arguments: costs matter more than almost anything else in investing. While many investors focus on returns, strategies, or manager skill, Bogle insists that minimizing costs is the most reliable way to improve long-term results. The chapter begins with a simple principle: every dollar paid to fund managers, brokers, and advisors is a dollar subtracted from investor returns. This is not a metaphor, it is arithmetic. Gross market returns are shared between investors and intermediaries, and the higher the costs, the smaller the investor's share. Bogle breaks down the main components of fund costs: expense ratios, transaction costs from portfolio turnover, and hidden costs such as marketing and distribution fees. Individually, these costs may appear modest. Over decades, however, they compound into a substantial drag on performance. He presents long-term evidence showing a strong inverse relationship between fund costs and returns. Low-cost funds consistently outperform high-cost funds, not because they take more risk or make better decisions, but because they allow investors to keep more of what the market provides. The chapter challenges the belief that higher fees buy superior management. Bogle explains that while some managers outperform temporarily, costs are permanent and certain, while outperformance is uncertain and fleeting. Even skilled managers face competitive pressures that erode any advantage over time. Bogle also highlights how cost differences widen in low-return environments. When market returns are high, costs may feel less painful. When returns are modest, costs consume a much larger percentage of gains, making efficiency even more critical. A key takeaway is that cost control is fully within the investor's control. Investors cannot dictate market returns, interest rates, or economic cycles, but they can choose low-cost funds. This makes cost minimization one of the few dependable levers available. The chapter reinforces the structural advantage of index funds. Because they require no security selection or frequent trading, index funds operate at extremely low cost. This cost advantage compounds year after year, creating a significant long-term edge over actively managed alternatives. Bogle concludes Chapter 11 with a clear rule: in investing, you get what you don't pay for. By focusing relentlessly on low costs, investors tilt the odds in their favor not through prediction or complexity, but through discipline and arithmetic. This chapter solidifies the book's central message: keeping more matters more than earning more. Chapter 12 presents John C. Bogle's core solution to nearly every problem. Discussed in the earlier chapters, own the entire stock market through low-cost index funds. This chapter moves from theory to implementation, explaining why simplicity is not a compromise, but a competitive advantage. Bogle begins by restating the fundamental reality of investing. The stock market's total return is generated by dividends and earnings growth. Over time, these returns accrue to those who own the businesses. Index funds are designed to capture this return with minimal interference. Instead of attempting to select individual stocks or outperforming managers, A total market index fund holds virtually every publicly traded company. This ensures full participation in economic growth, including exposure to both current leaders and future winners that cannot be identified in advance. The chapter emphasizes that indexing is not about average results. It is about assured relative success. Since active managers collectively are the market before costs and underperform after costs, an index fund that minimizes costs will, by definition, outperform most active strategies over time. Bogle highlights 3 structural advantages of index funds: ultra-low costs, with no need for research, forecasting, or trading. Index funds operate at a fraction of the cost of active funds. Broad diversification. Owning the entire market reduces company-specific risk and eliminates the danger of missing key contributors to returns. Low turnover, minimal trading reduces transaction costs and tax liabilities, allowing returns to compound more efficiently. The chapter addresses a common misconception that indexing is settling for mediocrity. Bogle argues the opposite. Indexing guarantees the market return minus minimal costs, which over decades places investors ahead of the majority who attempt and fail to do better. Bogle also discusses the emotional benefit of simplicity. Index investors are less tempted to trade, chase performance, or react to market noise. This behavioral advantage helps investors stay invested during volatile periods, which is essential for long-term success. Importantly, Chapter 12 does not claim that markets are perfectly efficient at all times. Instead, Bogle argues that even if inefficiencies exist, they are extremely difficult to exploit consistently after costs. The burden of proof lies with those who claim otherwise. The chapter concludes with a clear recommendation. Investors should embrace the majesty of simplicity by owning the entire market, keeping costs low, and holding for the long term. This approach does not promise excitement, but it offers something far more valuable: reliable participation in the long-term wealth creation of capitalism. Chapter 13 shifts the focus from stocks to bond funds and money market funds, showing that the principles of cost control and arithmetic are even more important. In fixed income investing, Bogle begins by explaining a key difference between stocks and bonds. Stock returns are driven by long-term business growth, which can offset some mistakes. Bond returns, however, are mathematically constrained. A bond's return is largely determined by its yield at purchase. There's no upside surprise from earnings growth, because bond returns are lower and more predictable. Costs consume a much larger share of total return. A 1% annual fee in a stock fund is harmful. In a bond fund, it can be devastating. In some cases, costs can absorb most or even all of the investor's real return. Bogle explains that many bond funds engage in active management, attempting to add value through interest rate forecasting, credit selection, or sector rotation. However, these efforts introduce higher expenses and turnover, with little evidence of consistent success. He emphasizes that bond markets are highly competitive and influenced by large institutional players. With vast resources, the odds that individual investors or active managers can consistently outmaneuver the market after costs are extremely low. The chapter also addresses money market funds, which are designed to preserve capital and provide liquidity. In this space, returns are already minimal. Any additional costs can reduce yields to near zero. Bogle argues that money market investing should focus almost entirely on safety and cost efficiency, not performance. Bogle reinforces that simplicity is even more valuable in bonds than in stocks. Broad, high-quality bond index funds offer diversification, low turnover, and minimal expenses. They capture the bond market's return with precision and reliability. Another important point is risk control. Active bond strategies often introduce hidden risks, such as longer duration or lower credit quality, in pursuit of higher yields. These risks may not be obvious to investors, but can lead to unexpected losses. During periods of market stress, Chapter 13 concludes with a clear recommendation. In fixed income, investors should prioritize low cost, high quality, and broad diversification. The goal of bonds is not to beat the market, but to provide stability, income, and balance within a portfolio. Bogle's message is consistent with earlier chapters. The relentless rules of humble arithmetic apply everywhere, but in bond investing, they are even more unforgiving. Keeping costs low is not just beneficial, it is essential. Chapter 14 examines a newer category of investment products that claim to combine the benefits of indexing with the potential to outperform the market. These are often described as enhanced, smart beta, or strategy index funds. John C. Bogle approaches these products with skepticism and applies the same arithmetic used throughout the book. Bogle begins by acknowledging that traditional index funds simply track a market benchmark, usually weighted by market capitalization. Newer index strategies attempt to improve on this by weighting stocks based on factors such as dividends, earnings, volatility, momentum, or fundamental metrics rather than market value. While these approaches are often marketed as innovative, Bogle argues that they are not truly passive. They involve active decisions about which factors matter, how they are measured, and how portfolios are rebalanced. As a result, they introduce manager judgment, higher turnover, and higher costs. The chapter emphasizes a critical point. Any attempt to outperform the market transforms indexing into a form of active management. Once that shift occurs, the same problems reappear: costs, taxes, trading friction, and the risk that past factor performance will not persist. Bogle analyzes historical data, showing that factor-based strategies often experience cycles of outperformance, followed by long periods of underperformance. Investors who adopt these strategies frequently do so after strong recent results, which reduces future expected returns. Another issue Bogle highlights is data mining. Many strategies are built by analyzing historical data to find patterns that worked in the past. However, patterns discovered retrospectively do not guarantee future success. Once widely adopted, any advantage is likely to be arbitraged away. Costs play a central role in Bogle's critique. Enhanced index funds typically charge higher expense ratios than traditional index funds, and often incur higher transaction costs due to rebalancing. These costs create a higher hurdle that must be overcome just to match the market. Bogle does not argue that all alternative index strategies will fail. Instead, he stresses that the burden of proof is high and investors should remain cautious. The simplicity, transparency, and low cost of traditional market cap-weighted index funds remain their greatest strengths. Chapter 14 concludes with a reminder of the book's central philosophy. The more complex an investment strategy becomes, the more likely it is to benefit its creators rather than its investors. While innovation can be appealing, the timeless arithmetic of investing still applies. For most investors, Bogle suggests that owning the market at minimal cost remains the most reliable path to long-term success. Chapter 15 examines exchange-traded funds (ETFs) and their role within the index investing framework. John C. Bogle presents a balanced view. ETFs are structurally efficient investment vehicles, but they also introduce behavioral risks that can undermine long-term returns. Bogle begins by explaining how ETFs work. Like traditional index mutual funds, ETFs typically track a market index and offer diversification at low cost. Unlike mutual funds, however, ETFs trade continuously throughout the day on stock exchanges, with prices fluctuating in real time. From a structural standpoint, Bogle acknowledges several advantages of ETFs. They often have low expense ratios, are tax efficient, and provide broad market exposure. For long-term investors who buy and hold, ETFs can serve the same purpose as index mutual funds. The concern arises from how ETFs are used, not how they are built. Because ETFs trade like stocks, they encourage frequent trading, speculation, and market timing. Bogle argues that this feature conflicts with the core philosophy of index investing, which emphasizes patience, discipline, and long-term ownership of businesses. He points out that ETFs have increasingly become tools for traders rather than investors. Many ETFs are designed to target narrow sectors, countries, styles, or leverage strategies. These specialized ETFs increase complexity, turnover, and risk often without improving long-term returns. Bogle emphasizes that liquidity can be a double-edged sword. While it provides flexibility, it also tempts investors to react to short-term market movements. The ability to trade instantly does not improve investment outcomes. In many cases, it worsens them by increasing costs and behavioral errors. Another issue discussed is price versus value. ETF prices can deviate slightly from the net asset value of their underlying holdings during periods of market stress. While arbitrage mechanisms usually correct this, it adds another layer of complexity that long-term investors do not need. Bogle contrasts ETFs with traditional index mutual funds, which transact only once per day at net asset value. The structure naturally discourages short-term trading and aligns better with long-term investing principles. The key message of Chapter 15 is not that ETFs are bad investments. Rather, ETFs are neutral tools whose effectiveness depends on investor behavior. Used properly as long-term holdings of broad market indexes, they can be effective and efficient. However, when ETFs are used for speculation, rapid trading, or tactical allocation, they violate the very principles that make indexing successful. Bogle concludes with a warning: technology and convenience do not change the arithmetic of investing. Long-term success still depends on low costs, diversification, discipline, and patience regardless of the investment vehicle. Chapter 16 addresses a key question for traditional investors. Would Benjamin Graham, the father of value investing, have supported index investing? John C. Bogle argues that not only would Graham have approved of indexing for most investors, but that his principles strongly support it. Bogle begins by reviewing Graham's core philosophy. Graham believed that successful investing required discipline, a margin of safety, and protection against serious mistakes. He also acknowledged that most investors lack the time, skill, and emotional control needed to consistently outperform the market. Graham distinguished between two types of investors: enterprising investors, who actively analyze securities, and defensive investors, who seek reliable results with minimal effort and risk. For defensive investors, Graham recommended broad diversification, low costs, and a long-term approach. Bogle argues that index funds perfectly align with Graham's defensive strategy. By owning the entire market, investors eliminate security selection risk. By keeping costs low, they preserve their margin of safety. By holding long-term, they avoid emotional decision-making. The chapter then introduces Warren Buffett's explicit endorsement of index investing. Buffett has repeatedly stated that most investors and even most professionals would be better off owning a low-cost S&P 500 index fund rather than trying to pick stocks or hire managers. Bogle highlights Buffett's reasoning. While exceptional investors exist, they are extremely rare and difficult to identify in advance. For the vast majority of people, the simplest approach produces superior long-term results. Buffett's view reinforces Bogle's central argument. Index investing is not anti-intellectual. It is realistic. It recognizes the limits of forecasting, the power of compounding, and the certainty of costs. The chapter also addresses a common misconception, that indexing conflicts with value investing. Bogle explains that the market itself reflects all styles: growth, value, large cap, small cap. By owning the market, index investors automatically participate in all of them, without needing to rotate or predict which will outperform. Another important point is humility. Both Graham and Buffett emphasized knowing what you cannot know. Indexing embodies this humility by refusing to speculate on short-term price movements or manager skill. Chapter 16 concludes by positioning index investing as the modern expression of Graham's defensive investing philosophy. It offers broad diversification, low cost, tax efficiency, and behavioral discipline, all core Graham principles. Bogle's message is clear. Index investing is not a rejection of investing wisdom. It is its logical evolution, endorsed by both Benjamin Graham's framework and Warren Buffett's real-world success. Indexing stands as a prudent choice for long-term investors. Chapter 17 returns to the central mathematical truth of the book, the relentless rules of humble arithmetic. This chapter serves as a reinforcement of the core logic that underpins all of Bogle's arguments, logic that cannot be debated, negotiated, or ignored. Bogle restates the fundamental equation of investing. Gross return minus costs equals net return. At the market level, Investors collectively earn the total return generated by businesses' dividends plus earnings growth. However, once costs are introduced, investors as a group must underperform the market. These costs include management fees, transaction costs, advisory fees, taxes, and the indirect costs created by excessive trading. The chapter emphasizes that this is not a flaw in markets, it is inevitable arithmetic. Since all investors together are the market, any attempt to beat it merely redistributes returns before costs. After costs, the outcome becomes negative sum. Bogle reinforces that time magnifies this effect. A small annual cost difference, often dismissed as insignificant, compounds dramatically over decades. What appears trivial in a single year becomes decisive over a lifetime of investing. The chapter also revisits investor behavior. Many investors believe that intelligence, research, or experience can overcome costs. Bogle argues that while skill may exist, costs are certain while skill is not. Even above-average performance is often overwhelmed by below-average expenses. Another key point is that costs increase with activity, frequent trading, manager changes, tactical allocation, and performance chasing all introduce friction. Investors who attempt to improve results through action often reduce them instead. Bogle contrasts this with the structural advantage of indexing. Index funds accept market returns and minimize costs, allowing investors to keep the largest possible share of what businesses generate. This approach does not rely on forecasts, selection, or timing-only arithmetic. The chapter also serves as a reminder that simplicity is not naive. It is a rational response to a system where complexity benefits intermediaries more than investors. The financial industry profits from activity. Investors profit from restraint. Chapter 17 concludes by reaffirming the book's central message. Successful investing is not about brilliance, speed, or prediction. It is about discipline, humility, and cost control. The relentless rules of humble arithmetic apply to every investor, in every market, at all times. Those who respect them improve their odds. Those who ignore them pay the price. This chapter reinforces why the index strategy is not just sensible, but mathematically unavoidable for long-term success. Chapter 18 shifts from theory to practical guidance, addressing the question every reader eventually asks: what should I actually do as an investor? John C. Bogle introduces a clear framework to help investors apply the principles of the book in real life. Bogle begins by distinguishing between serious money and funny money. Serious money represents the assets investors rely on for long-term goals such as retirement, financial security, and future spending. This money should be invested conservatively, with a disciplined strategy designed to maximize the probability of long-term success. Funny money, by contrast, refers to a small portion of assets that investors may choose to use for speculation, experimentation, or personal interest. Bogle does not encourage speculation, but he recognizes that some investors will pursue it regardless. His key rule is that speculative activity must never jeopardize serious money. For serious money, Bogle recommends a simple, diversified asset allocation based on stocks and bonds. Stocks provide long-term growth through ownership of businesses, while bonds provide stability and income. The exact allocation should reflect the investor's risk tolerance, time horizon, and need for stability. He emphasizes that asset allocation matters more than fund selection or market timing. Once a sensible allocation is chosen, it should be maintained through disciplined rebalancing, not emotional reactions to market movements. Bogle reiterates that low-cost index funds are the most effective building blocks for this strategy. Broad stock market index funds and high-quality bond index funds offer diversification, cost efficiency, and transparency. The chapter also addresses the importance of long-term commitment. Investors should expect periods of underperformance, market declines, and uncertainty. Abandoning a strategy during difficult periods is one of the most common and costly mistakes. Bogle warns against excessive tinkering. Frequent changes in allocation or strategy often reflect emotional responses rather than rational analysis. Stability and consistency are critical to capturing long-term market returns. For investors who choose to allocate some money to speculation, Bogle sets strict boundaries. Funny money should be limited in size, clearly separated from long-term assets, and mentally treated as expendable. Losses should not affect financial security. Chapter 18 concludes by reinforcing a central message of the book. Successful investing is not complex, but it is demanding. It requires discipline, patience, and the ability to resist temptation. By treating serious money with seriousness, low cost, broad diversification, and long-term commitment, investors give themselves the best chance to achieve their financial goals. Chapter 19 focuses on retirement investing and examines funds that automatically manage asset allocation, particularly target date funds and balanced funds. John C. Bogle evaluates whether these solutions help investors apply sound investment principles or introduce new risks and costs. Bogle begins by reaffirming a key principle. Asset allocation is the most important investment decision most investors will ever make, especially for retirement accounts. The mix between stocks and bonds largely determines both long-term return and portfolio volatility. For retirement investors, Bogle emphasizes the need for simplicity, discipline, and consistency. Many individuals lack the time, interest, or expertise to actively manage and rebalance portfolios. This reality has led to the growth of funds that automatically adjust asset allocation over time. Target date funds are designed around a specific retirement year. As the target date approaches, the fund gradually reduces stock exposure and increases bond exposure. Balanced funds, by contrast, maintain a relatively stable allocation between stocks and bonds. Bogle acknowledges that these funds can provide real benefits. They offer automatic diversification, regular rebalancing, and behavioral protection. By removing the need for frequent decisions, they reduce the likelihood of emotional mistakes such as panic selling or performance chasing. However, Bogle raises several cautions. First, not all target date funds are created equal. Asset allocation glide paths vary widely across providers, leading to very different risk profiles for investors with the same retirement date. Investors often assume uniformity where none exists. Second, costs still matter. Some target date and balanced funds include actively managed components or higher expense ratios. These additional costs reduce long-term retirement outcomes, even if the structure appears convenient. Third, Bogle emphasizes that one-size-fits-all solutions may not fit everyone. Investors differ in risk tolerance, outside assets, and income sources. Blindly accepting a preset allocation without understanding it can lead to unintended risk exposure. Bogle reiterates that low-cost index-based target date funds are generally superior to actively managed versions. Index-based structures preserve the advantages of automation while minimizing cost drag. Another important point is investor responsibility. While these funds simplify execution, investors should still understand the basic logic of their allocation and remain committed during market downturns. Chapter 19 concludes by reinforcing a balanced view. Automated asset allocation funds can be effective tools for retirement investing, but only when they adhere to the same core principles outlined throughout the book: low cost, broad diversification, discipline, and long-term focus. Convenience does not override arithmetic, even in retirement investing. What matters most is how much of the market's return investors are able to keep. Chapter 20 serves as the final synthesis of the Little Book of Common Sense Investing, distilling John C. Bogle's investment philosophy into a set of enduring principles designed to withstand market cycles, economic change, and investor emotion. Bogle begins by emphasizing that good investment advice does not change frequently. Markets evolve, products multiply, and technology advances, but the fundamental arithmetic of investing remains constant. Strategies that rely on prediction, complexity, or frequent activity continue to fail for the same reasons they always have: costs, taxes, and human behavior. The chapter revisits the core premise of the book: investors as a group earn the market return before costs and less than the market return after costs. This reality makes beating the market unlikely and unnecessary. The more important objective is capturing as much of the market's return as possible. Bogle reiterates the essential elements of a sound investment strategy: broad diversification, to reduce risk and ensure participation in long-term economic growth. Low costs, to minimize the drag on returns. Long-term discipline, to allow compounding to work. Simplicity, to reduce mistakes and behavioral errors. He stresses that these principles are timeless precisely because they are grounded in logic, not fashion. The chapter also addresses the role of behavioral discipline. Bogle notes that even the best strategy will fail if investors abandon it during periods of fear or euphoria. Staying the course during market downturns is difficult, but it is essential. Emotional reactions, panic selling, chasing returns, and constant tinkering remain the greatest threats to investor success. Bogle criticizes the financial industry's focus on novelty. New products, strategies, and narratives are often presented as solutions, but most primarily benefit intermediaries rather than investors. Complexity creates opportunity for fees, not for superior long-term outcomes. In contrast, index investing stands as a strategy built to endure. It does not depend on forecasts, manager skill, or market timing. It depends on ownership, efficiency, and patience. Chapter 20 concludes with a clear message. Successful investing is not about intelligence or effort. It is about alignment with reality. By accepting market returns, minimizing costs, and maintaining discipline, investors dramatically improve their odds of achieving long-term financial goals. Bogle frames this approach not as a guarantee, but as the most reliable path available. In a world of uncertainty, common sense applied consistently remains the investor's greatest advantage. At its core, the Little Book of Common Sense Investing delivers one message that is both uncomfortable and liberating. Most investors don't fail because the market is unfair. They fail because they give too much of their return away. John C. Bogle systematically dismantles the myths that dominate modern investing. He shows that beating the market is not only difficult, but unnecessary. Before costs, all investors as a group earn the market return. After costs, fees, taxes, trading, and behavioral mistakes, they earn less. This is not an opinion, it is arithmetic. Throughout the book, Bogle draws a sharp distinction between business reality and market expectations. Over the long run, stock returns are driven by dividends and earnings growth. Speculation, valuation changes, forecasts, and narratives may dominate headlines, but they cancel out over time. What remains is the fundamental return of businesses. The problem is not that investors lack information. The problem is too much activity. Trading, performance chasing, fund switching, and complex strategies all introduce friction. Each layer of complexity benefits intermediaries more than investors. Bogle's solution is intentionally simple. Own the entire market, keep costs low, and hold for the long term. Index funds are not presented as a shortcut or a compromise. They are presented as a structural advantage. By accepting market returns and minimizing costs, investors place themselves ahead of the majority who attempt to do better and fail. The book also emphasizes behavior. Even the best strategy collapses without discipline. Panic selling, chasing winners, and reacting to short-term noise are recurring themes behind investor underperformance. Simplicity is not just an investment strategy, it is a behavioral defense. Bogle does not claim certainty about future returns. Instead, he offers something more valuable: control. Investors cannot control markets, but they can control costs, diversification, asset allocation, and time in the market. Across stocks, bonds, retirement accounts, ETFs, and advisory decisions, the same rule applies. What you don't pay, you get to keep. The book ends where it began, with humility. Successful investing does not require brilliance, prediction, or constant action. It requires accepting reality, respecting arithmetic, and staying the course. In a financial world built on excitement, the Little Book of Common Sense Investing argues for something radical. Boring works, and over time, boring wins. If this summary helped you see investing more clearly, hit like so more people can find this video. If you want practical, no hype breakdowns of the books that actually shape financial thinking, subscribe to the channel and comment below. Are you investing like an owner or still trying to beat the market? Thanks for watching. See you in the next breakdown.